What's up guys and welcome back to Wall Street Millennial. If you're new to this channel, we make videos about epic investment gains and losses. Today we are covering one of the biggest fails in the history of investing that almost crashed the world economy. Check out the link in the description below to get 4 free stocks when you deposit $100 into Webull. It's literally free money, so why wouldn't you do it? And it also supports the channel. With that being said, let's get into the video. The fail in question is Long-Term Capital Management, or LTCM for short, a highly leveraged derivatives trading hedge fund founded in 1994. They raised billions of dollars and employed massive amounts of leverage to make YOLO option strategies, which ultimately ended up in complete disaster when they lost everything and almost crashed the world economy. It's one thing for a Wall Street Bets user to lose a lot of money on a YOLO, but this is on a completely different scale. LTCM owned a portfolio of financial derivatives that connected them to numerous counterparties across the financial industry. Similar to Lehman Brothers' failure in 2009, LTCM's failure threatened to bring down the entire financial system. Luckily, the Federal Reserve stepped in at the last minute and gave them a $3.6 billion bailout, averting an economic disaster. But this gave little consolation to LTCM's investors, who lost almost 100% of the billions they invested. So how did this all happen? LTCM was founded in 1994 by John Meriwether, who was the head of bond trading at Salomon Brothers, one of the leading investment banks at the time. He made a lot of money trading treasury securities, but in 1991, he was forced to resign after one of his subordinates was caught up in a trading scandal involving some type of market manipulation. After his resignation from Salomon Brothers, he founded a hedge fund called LTCM. To gain credibility with investors, he hired Myron Scholes and Robert Burton to join the company's board of directors. They were both highly respected academics, having held academic positions at MIT, the University of Chicago, and Stanford. They also jointly won the Nobel Prize in Economics for their work inventing Black-Scholes, which is used to value options. The other partners of long-term capital included many professors and leading economists. They included David Mullins, former vice chairman of the Federal Reserve, who holds a PhD from MIT and a professorship at Harvard, Eric Rosenfeld, who also holds a PhD from MIT and is a former professor at Harvard Business School, William Krasker, again an MIT PhD and Harvard Business School professor, Greg Hawkins, again an MIT PhD. LTCM used the credibility of their Nobel Prize-winning directors to raise over $1 billion to start off with. They raised money from a wide range of institutions, including university endowments and even Banca Italia, the Italian central bank. The investors thought their money was safe under the stewardship of 2 Nobel Prize-winning academics. As it turns out, they couldn't have been more wrong. LTCM's strategy centered around a type of trade which they called fixed income arbitrage, which was actually just a kind of convergence trading. This worked by using a quantitative model for the values of fixed income securities, such as bonds, to identify instances where 2 similar securities diverged in price from their modeled value. For example, the most recently issued US Treasury bond, commonly referred to as the benchmark, trades at a premium to the previously issued benchmark because it is more liquid and transaction costs are lower for trading it. However, this difference in pricing is due to liquidity rather than value on an individual basis. Because of this, one could assume that at some point in the future, when their prices converge to their true values as it becomes closer to expiry, their relative valuations will also converge to their true ratio. This would allow a trader to short the overpriced leg and long the underpriced leg, and thus hedge themselves against overall changes in market sentiment while profiting from the supposedly inevitable convergence in price. Because these trades are hedged to the price action of fixed income markets as a whole, and even to movements of similar securities, they were considered by some to be very safe, giving them the elusive label of arbitrage. However, the amount of profit on each trade was very small because of this, and also because of the fact that many other firms were also engaging in these types of trades. In order to increase their returns, LTCM employed extreme amounts of leverage and accumulated a debt-to-equity ratio of 25-1. As a comparison, brokerage accounts such as Robinhood and other retail brokers are only allowed by law to offer a maximum of 2-1 for brokerage accounts. LTCM was able to attain this amount of leverage through their high-power reputations and academic credentials. In order to maximize diversification and find suitable opportunities, LTCM employed this style of strategy on a wide range of securities in many markets, especially illiquid ones. These trades ranged from US and Euro swap spreads to Japanese and Italian fixed income. However, even from the beginning, there was skepticism as to the safety of their strategy. Celebrated hedge fund giant Seth Klarman, known as the Oracle of Boston, said of long-term capital strategy that it is reckless to have the combination of high leverage and assuming the non-existence of extreme outlier scenarios. In the late 90s, financial markets in Asia began to show signs of strain. This caused spreads between LTCM's positions to widen even further, causing large monthly losses, but also convincing the partners to double down under the assumption that they would eventually return to fair value. However, due to their high operating leverage, when the Russian financial crisis of 1998 hit, there was an ensuing flight to safety, and this meant that most liquid and benchmark securities which LTCM was shorting skyrocketed in value. As other smaller funds also started liquidating similar positions to cover their losses, this compounded the problem even further for LTCM. In only 3 weeks, the value of their portfolio crashed from more than $2 billion to only $400 million, with a debt-to-equity ratio of 250 to 1. This caused them to become unable to service their liabilities, requiring a bailout. The reason why their strategy failed so spectacularly was because of the extreme leverage and accompanying rare event risk. Their strategy was basically like selling naked puts on illiquid bonds and hedging by longing similar maturity bonds with slightly higher quality and liquidity. This allowed them to make a small amount of money in most environments, but when a flight to liquidity happened, these positions lost a ton of money, compounded by their massive leverage. This all happened within only a few years of starting the fund. When their fund started to tank in 1997, this threatened the entire financial system. LTCM borrowed money from a wide web of financial counterparties, and if they failed to make good on their financial obligations, they could easily have taken down many other financial institutions with them. By 1998, it was becoming obvious that LTCM was running out of money, and they needed to raise more capital just to survive. Warren Buffett offered to buy them out for $250 million, but LTCM's management arrogantly turned down the offer, thinking that their fund was still worth more than that despite losing almost everything. Soon, the New York Federal Reserve stepped in to clean up the situation. They wanted to avoid a financial panic, which could easily have ended up in a 2009-level disaster if financial markets froze. They ended up organizing a private sector bailout to the tune of $3.625 billion to save LTCM from collapse, and they gradually wound down the fund in 2000. While private sector banks such as JP Morgan and Goldman Sachs supplied the money for the bailout, there is an implicit guarantee from the New York Fed that they would cover the losses if things went south. Many market participants and academics consider the LTCM bailout as marking the beginning of the Fed's long path towards establishing moral hazard. Because financial institutions expect the Fed to come in and save them if things go awry, they are motivated to take on more and more risk. Many people believe that moral hazard is what caused banks to take on so much leverage leading up to 2009, with disastrous results. If you haven't already, click the link in the description below to get 4 free stocks when you deposit $100 into Webull. The value of the stocks range from at least $21 to up to $3,700, and Webull is a free trading app, so it's literally free money. Why wouldn't you do it? On top of that, many people prefer it to Robinhood because it has a better interface, offers 3 months of free level 2 market data, and gives everyone full extended trading hours that last until 8 p.m. If you use our link in the description below, you are also supporting this channel. That wraps it up for this video. If you like this content, make sure to like, subscribe, and share this video. Leave a comment below if you have any thoughts on LTCM. As always, we thank you for your support. Wall Street Millennial, signing out.